p.m. only on BloombergQuint.
Hello and welcome to Hot Money on BloombergQuint Live, India's first digital live streaming business news service. This is the show which gets you a complete wrap of all the stocks that are buzzing in trade. I'm Darshan Mehta. Let's welcome our expert there, Vineeta Sharma of Narnolia Financial Advisors, Senthil Manikandan of Newberry Capital, and independent investment advisor Vivek Mawani join us on the show. Thank you to all for joining me on the show. Today on Hot Money, we'll discuss stocks like Mindtree versus the Midcap IT, because Mindtree hasn't fallen as much as the most IT stocks, so is valuation a concern? HUL will analyze the numbers what came out. Power utilities of late have started doing well. Counters like REC, PFC have started doing well. What's the view on power utilities? And we ask whether any stock they feel that should be accumulated in this fall, with a large cap or a mid cap. We leave it open to our guests. But let's start with the first one, and that is Mindtree. Mindtree was extremely volatile on Friday. It did manage to correct significantly, but then managed to recover. So somehow, compared to the other IT stocks, Mindtree has managed to hold on. While counters like NIIT or a KPIT have fallen significantly, Mindtree is now doubled in the past 12 months. Is valuation a concern? Would you buy Mindtree at this level? We'll ask our guests. So Senthil, what's your view on Mindtree?
So like you mentioned, I think the stock has been pretty strong because it has to do with the revenue growth, what they've done in the last 3 quarters. If you look at the revenue growth, it has been in the range of 15 to 20%. Even in Q1 with 20% revenue growth, it has been the highest among the mid-tier IT pack. And the management commentary, I think if you look at the Q1 deal wins also quite robust. Plus the management commentary for the next 1 to 2, 3 years, they are eyeing for a same kind of growth. And if you look at the entire IT industry, it has been in the transformation phase. And among the mid-tier IT companies, one or two companies are only in the transformation phase. Like for the persistence, they are looking for a product-centric approach. Same way, I think Mindtree also focusing much on the emerging technologies. And even in the digital contributes around 47% of their revenues. So going forward with the transformation phase on track, I think the margin growth will be good. I think they posted a 14.5% margin in Q1. I think the margin accretion is also possible going forward. On the negative side, I could say that the client concentration risk is very high in the Mindtree. I think the top client contributes around 20% to the revenues. So it's a risk. If you look at the TCS, it's very diversified client base. And second risk, I could say that if you look at in Q1, they have contributed some $2 million for a AI chair in Stanford, and management is looking for a further contribution in that. So this was a later margin dilution in Q1. So we have to watch out for how this endowment contribution goes forward in the future years, how it contributes towards their patent accumulation or things like that.
So if someone's looking to take a call on Mindtree, would you recommend accumulating at this level, or would you recommend accumulating on declines, or would you stay away at all?
So I could recommend them accumulate on declines, because currently after a 17, even from the top it has fallen from 15%. So it's now trading at around 17-18 times 1 year forward earnings. Considering the growth potential, I could say that it's a accumulate on decline.
Okay, what about you, Vineeta? You all have formal coverage on Mindtree?
Yeah, Darshan, we have a formal coverage, and our price target is around 1250 or so. And Mindtree, as Senthil was pointing out, that it has gone through a major turnaround in the past 2 years, when the sales growth were around sub 10%. For 18 and 17 it was 12%, and now we are expecting some 25% top line growth. And Mindtree has, in the past 2 years, there has been a lot of changes in even the companies. They have tried to adjust to the new digital phase. Mindtree has some 45% contribution towards the digital thing, and Mindtree's customers Mindtree is very well resonated with the customers on the digital space. Secondly, if you look at the margins were for the past 2 years, they were on a declining phase, and through new acquisitions, new deals, as well as the new deal has been a little softer, but the renewal of the older deals has been pretty good, and margins right now it is around expected to be 16% plus. So I would say it's a very good bet in the sense, if we want to analyze the mid-cap IT space, in the mid-cap IT space, I assume that Mindtree should outperform the industry.
Okay, that's the view. And valuation wise, are you comfortable with the valuation?
Yeah, because for the 2 years, the value Mindtree has not grown. The revenues and EBITDA margin or PAT has been subdued. So the company is around giving around 40% plus PAT growth for FY19, 25% plus for FY20. So we are valuing around 20 times FY20 EPS.
Which is fine for you.
Which I think it should
be
Vivek,
fine. What's your view on Mindtree?
Actually, I don't track it in very much detail, so I'll reserve my comments at this point of time. But about two things that I would like to mention, that I see the flash at the bottom of the screen in terms of Mindtree for the we play on the weak rupee. I think the currency play as far as the IT stocks is concerned, I think we are done with for large part in terms of rally. So if somebody is betting on rupee weakness as an opportunity for IT stocks, I think that trade is pretty much done. That's number one. Number two, as far as the weakness of the currency is concerned, translating into higher margins for IT companies, I think historically it has not really played out that way. What you have is probably only a slight margin improvement for a quarter when rupee weakness has been fairly sharp. But eventually their pricing with the customers adjust such that over the long term, when you see, and even if you see annualized, there's not really expansion of margin because of the weak currency. So there I would have this view that as far as IT stocks are concerned, I mean, all of them we need to see as to what growth outlook they have going forward, but not really look at weakness of the currency INR as really an opportunity for upside. Having said that, I'll reserve my view on Mindtree because I don't have a detailed tracking in that sense. So that's the only comment I can make.
Okay, that's about it. The inflation numbers are out. September primary food inflation at 2.97%. I think overall inflation came in line with what the street was anticipating. July inflation revised to 5.27%. So all the flashes are on, so it's 5.13 versus an estimate of 5%, slightly higher. So that's the inflation number that's come out on this thing. The next stock we want to talk about is HUL. Now HUL has been seeing a lot of weakness. Even ahead of the numbers, the counter was down in trade. Today also the counter posed the numbers. So it was an inline set of numbers. Volume growth came in line with estimate. But the concern seems to be what next, because they grew 4%. They grew 10% on a base of 4%. Now the base is keeps on going higher. Will a double-digit volume growth be possible for HUL going ahead, or is that a concern? We'll ask our guest, Vineeta. What did you all make of HUL's number? Were you happy with it?
So HUL number volume growth was 10%, which was a little above than what we were expecting.
Yeah.
We were expecting around 9%. So we are pretty happy with the volume growth the company has made, and also going forward, certainly this kind of volume growth will be a little bit of a problem. Maybe it is not that possible on a high base, because last 4 quarters we have seen double-digit volume growth for HUL. If you look at the different segments, so the home care segment, which is around 33%, it has grown by 13% volume growth. Then the beauty side, the volume growth was around 11%. And the food and refreshment, the volume growth was 12%. So across the segments, volume growth has been pretty good for HUL. Now going forward, volume growth, because the management is concentrating on certain strategies, like one is a rural growth, which is continuing the volume growth, and secondly the company is adopting a YMI strategy. So in which the company is getting focused on particular clusters of India and redesigning the product little bit towards favor of the demographic side of the country. So that appears to be very good. Considering the volume growth, what concerns us is the margin right now, because after 5 quarters HUL has seen a gross margin decline, and for long the HUL management has been focused on increasing the operating leverage, or you can say the other expenses, advertisement expenses were controlled, and that was giving boost to the overall EBITDA margin. Now going forward, how much lever the management will have because of currency depreciation as well as raw material costs going high. So it will be a little bit of a problem to have that kind of a margin going forward.
What's the target that you all are giving to your clients?
So we have 1860 round target for HUL, but immediately I would not say that somebody should just immediately go and buy it, and we can have a accumulate kind of a view for this stock.
Okay, accumulate on decline. Vivek, what did you make of HUL's number? Is it something that you would recommend at this point of time?
Well, not recommend buying, but if we were to break up the argument between the business growth and the stock price, from the business growth point of view, of course, at double-digit volume growth, it seems a consensus that may not sustain unless the company surprises on the positive side in the next few quarters. But my sense is a high single-digit 7, 8, 9% kind of volume growth may sustain on back of the growth in rural areas. Even now, for the numbers that they have reported, rural growth was significantly higher than the urban growth by a factor of almost 40% or 50%, depending upon which product category we are looking at. That's number one. Number two, the input price inflation did put pressure on the gross margins, but as Vineeta mentioned, tight control on other costs led to still result in margin improvement. And if we now look at the margin, EBITDA margins, they are probably at the peak. Peak in the sense they've been highest in the last few years. So we really, so hence we call it a peak. We don't know whether it's really a peak because they can still go up on back of premiumization, on back of better revenue mix, or on as a result of a slight correction in the commodity prices itself, or even the rupee dollar slight pullback from the current levels, and you could have gross margins improving by maybe half or 1% going forward. So that's possible. In terms of valuations, if I were to, I'm not done with the business side. So 7 to 9% volume growth is sustainable according to my opinion, resulting in about 12%, 10 to 12% sales growth, and about 13 to 15% earnings growth on back of higher other income, because it's a debt-free, free cash flow generating company, and as I mentioned, better revenue mix, premiumization of the product portfolio, and so on and so forth. So that's possible. Now, from a valuation point of view, it's already at about 55 times current year earnings, perhaps about 45 to 46 times 1 year forward earnings, assuming 18 to 20% growth rate, which seems a lot of experts out there seem to be assuming that kind of growth rate. Now, it's certainly not cheap. Now, so hence, I would not be a buyer at these prices and valuations, but if it were to correct to something like 1400 or maybe even lower, which with the way some of these stocks have corrected in the last few weeks, it is very much possible that you may get it in the region vicinity of 1300, and that probably I'll be a buyer at those prices.
So if that's the view, should someone short this counter if someone is on the?
Well, I wouldn't say short either, because relative to rest of the stocks in the Nifty, HUL, let's not forget, HUL is also a Nifty heavyweight, and relative to most of the Nifty stocks which have corrected more than 20%, HUL actually has not corrected as much. So although we talk of weakness, I think from the top it's only corrected about 10% if I remember the numbers right. So one really doesn't short stocks which are strong. One shorts stocks which display some element of weakness, and HUL still doesn't display that level of weakness that one can go out and short.
Okay, Senthil, of late you've been rather negative on HUL, and the price has come down significantly. Are valuations now justifiable, or you still believe that you're expensive, and obviously your view on the numbers?
So first on the numbers, I think the positives has been like the rural outgrowing the urban by 25%. So with respect to HUL, I think they're heavily penetrated in the rural versus the other FMCG players.
Okay.
On the product segments, I think if you look at the three segments, home care and personal care as a product wise, both are heavily penetrated, both in rural and in urban. Food segment is the growing segment, and if you look at the peers like Nestle or Britannia could outperform HUL in the long term, because if you look at the long term, when the discretionary spending is going to increase as the per capita GDP goes up from $2,000 upwards. So I think obviously the beneficiaries would be those who are present in the packaged foods and beverages segment like Nestle or Britannia. So with this, I think we remain quite negative on HUL for this basic reason. On the valuation side, I think it's quite expensive because it stays around 46 times on year earnings. But it's a solid presence, product, everything is looking good, and business may grow at around 7 to 8%, but the multiples don't justify the kind of growth that the business will potentially deliver.
Okay, so that's the view that's coming in on the heavyweight HUL. Let's move on to the next one, and it's a sector, it's the power utilities or the PSU power companies, and it can be any power company. But that's what we're asking our guest. Vivek, anything in the power segment that you like?
Oh yeah, firstly, it seems coincidental, I mean, about your question, but for per se, I really don't have compulsion to be in the power sector or power utilities sector, but the reason I say coincidental is because I do like CESC only for the demerger value unlocking, which is going to play out, and 31st October is a record date that has been put out by the company. So just to give a brief, CESC as it is, I mean, it's getting demerged into 4 companies, or there are going to be 3 spin-offs, and CESC will remain. So the 10 shares of current CESC will give 5 shares of CESC power generation, where they have about 1200 megawatts of generating capacity. There will be CESC retail, which is the Spencer's retail business. There's going to be 2 shares of CESC Ventures, which holds a First Source Solutions, a mall called Quest in Kolkata, and some other financial investments. And what remains of the CESC will be the power distribution business, which is largely in Kolkata and Howrah, but they also have distribution licenses in Kota, Bharatpur, and Bikaner as well, and Greater Noida. So the CESC 10 shares will result in 18 shares, including the 4 spin-offs. Now, generally, our experience has been that multi-business conglomerates, when they tend to demerge their businesses and list each business separately, there is certainly value unlocking from the point of view that sum of parts is always generally greater than the total. And in the last couple of years, we have seen umpteen number of examples of companies when they have spun off and listed their different businesses separately. The sum of the spin-offs is generally at least anywhere by 20 to 50% higher than the original. I mean, we saw it in the Grasim Aditya Birla Capital spin-off. We saw it in Tube Investments spin-off. Just to remember 2 of them which happened in the last 1 year. So CESC, which trades at about 920 now, my sense is 6 to 12 months down the line, when all the 4 companies will get listed, the sum total of all of it should be anywhere in the region of 12 to 1300 rupees. Okay. So in this kind of a market scenario, I find that an attractive opportunity.
Okay, what about you, Vineeta? See like CESC, any stock that you like in the power utility?
So like we in the power utility, we do not have too much coverage in most of the stocks. Definitely we are also liking CESC, considering the demerger that is planned. Just to add to what he said, so right now with the latest announcement, so CESC generation and distribution company will be the same, which will be CESC, and CESC will be demerged into three companies. And if you look at the generation, CESC generation business as well as the distribution part. So distribution, if you see, Kolkata is around 18 to 19% ROE is already, and it's a free cash flow generating company. And the Noida one, which is around 49% stake CESC has, and that is into a good growth spree. Other distribution franchisees are also started picking up. So that side of the business is very attractive in terms of free cash flow generation. If we come to the generation side, Dhariwal losses are minimizing off late, and Haldia is already doing better. If we look at the whole sum of total parts of CESC, our fair value calculation is around 1050 for all four business. Even on the Spencer, the company is targeting good sales growth and good number of store addition, and we are personally very bullish on the retail side of the business. So that's the take we have. In the power utility space, if somebody wants to have a good bet, and I think the other two companies should list by mid of December, the Spencer and the other ventures. So I think 1050 should be the fair value right now according to.
Okay, so two of our guests are bullish on CSC. What would your pick be?
So basically in the power sector, most of the companies are highly leveraged and debt heavy and asset heavy companies. But one sector we like is the exchange business, in which the IEX is a major market leader with around 97% market share. And if you look at the business wise, last 2 to 3 years, they have even acquired the technology. So it's like a pure play exchange business in the power sector. If you look at the financial numbers, their ROE of 40% and free cash flow generating businesses, and dividend payout is around 70%. So strong financials. And coming on to the business potential for the long term, currently the short term power market in India is around 10% of the total power market. If you look at the developed countries, it's in the range of 40 to 50%. And within the short-term power market, the exchange market share is around 18%. So in the last 3-4 years, exchanges have garnered market share from the bilateral licensed players. I think going forward also with increased transparency and flexibility, I think the market in the short term will move more towards the exchange. And IEX being the market leader, obviously they will be the mostly beneficiary. And one risk or concern which we have to watch out for is the new entrants in the place. I think BSE along with ICICI and PTC are looking to enter the power exchange business. So this is one thing you have to watch out for, but strong financials and ROE of 40%, and it's trading at around 30 times 1 year forward earnings. I think it looks like a good bit, and it's a accumulate on decline.
Okay, so IEX and CSC are the stocks being spoken about, and the final stock is basically one large cap or mid cap, which after the fall should be accumulated. Senthil, I'll start with you only. Which stock would you recommend?
So again, in exchange business, BSE. So if first on the valuation side, if you exclude the cash and the investment in CDSL, so we are getting the entire exchange business for a 200 to 300 crores. So it's a known fact that BSE has lost its market share in the equity derivatives and even in the equity cash. But last 5-6 years with the new management has come in, they have created a couple of new platforms like mutual fund. Currently, if you look at, they have started monetizing since a couple of quarters, and they are the market leaders in the mutual fund platform, plus in the SME platform and bond platform. So these are new platforms that they have created. And if you look at the INX also, they are doing well on the INX side. But so next 3-4 years, I think this new platforms will start monetizing. And on the valuation side is quite comfortable, because being strong on the balance sheet and generating ROEs, and the dividend payout is also ratio is also quite high, and we are getting it at the cheap valuations.
Okay, what about you, Vineeta? Which stock are you all liking?
We're liking Reliance, the top nifty stock, I would say. And if you look at the overall performance of Reliance and the standalone business, the petchem and the refinery. So the petchem has earlier it has grown by 61% in the last quarter, and the margins were around 23%. And similar, the volume growth in the petchem segment is still to continue. And overall, we are expecting good volume growth for the petchem segment. Considering the next business, which is Jio or the retail, so all the businesses of Reliance has been properly placed, and we expect good growth in all the segments. For Reliance, for FY19, we are expecting around 44% top line growth. So if a large cap company, be it Reliance, is the kind of sales growth and PAT growth the company is generating, so one can always have this company, because it becomes rare to have at a good valuation. Secondly, if you look at the Reliance Jio, the overall subscriber base, the management has said that the subscriber base, they are only going to target the number of subscriber. So they are going to cut short on some of the realization, which we are not very sure how it will play out. And home to fiber business. So all these businesses we feel should give a good growth to Reliance as such.
Okay, so there's BSE, there's Reliance, and Vivek, your final call. Which stock should viewers look at closely?
Yeah, so basically, instead of talking one single stock, I'll just talk of a couple of attributes of stocks that we should either avoid or look at. So firstly, companies which are likely to be having issues of growth. I mean, a lot of stocks have corrected and we think there is value, but it's quite possible some of them will become value traps that a couple of months or couple of quarters later we realize that they actually have growth issues and they may not actually come back to their prices that they were earlier. So avoid companies which may have growth issues going forward. Number two, avoid companies which probably need to raise capital, whether by debt or equity, to sustain their growth rates. I mean, if growth is dependent upon capital raising, my sense is capital raising, whether by equity or debt, is going to be increasingly getting difficult for large number of corporates. Extension to that, companies which have heavy debt balance sheets, a rising interest rate scenario, and especially companies which have forex liabilities, debt in overseas loans, your INR depreciation also is going to wreak havoc to those balance sheets. So avoid those companies which have these issues. Fourthly, companies which have management or governance related issues. I mean, there may not have been explicit news about any wrongdoing, but sharp falls in stock price to the extent of 40, 50, 60% itself suggests that there could possibly be some, so there's never really smoke without fire. So avoid even bottom fishing or value buying in some of those companies. So net, then what are the kind of companies that we look at? Companies which can sustain growth rates with their internal accruals, which generate positive free cash flows, have high return on capital, return on equity. So the kind of stocks that I'm looking at are, say, a Kotak Bank, Sun Pharma, Cipla, Bajaj Auto, Hero MotoCorp. I mean, these are among all the large caps. Among the mid caps, I mentioned CSE. CSE is actually only from a demerger point of view. KEI that I'd spoken about last week, which is the second largest cable company in India. A very good sustainable growth story with upwards of 20% return on capital, return on equity. So these are the kind of stocks that I'm looking at. A disclaimer, we already have interest in some of these companies and looking to buy more of it as they decline. Okay, so that's the view. It's a comprehensive view with multiple stocks that Vivek spoke about. But the final stocks I was spoken about was Reliance and BSE that the other two guests spoke about. But with that, it's a wrap on today's Hot Money. Vivek, Vineeta and Senthil, thank you so much for coming into the studio today. Ask BQ comes up next. Stay tuned to BloombergQuint.